In finance, few indicators hold as much intrigue as a yield curve. This graph plots the relationship between interest rates and bond maturities and has recently taken center stage with talk of its inversion. But what does this mean? Are we on the brink of financial turmoil? Hi, my name is Chris Kovalchuk and I'm a portfolio manager at Claret Asset Management. And in today's video, we delve into the mysteries of the inverted yield curve, exploring its implications and how it might help predict a recession. In order to understand why yield curve inversion matters, let's first look at the yield curve. The yield curve is a line graph that shows the interest rates or yields of bonds of different maturities. The yield curve plots the relationship between the interest rate, yields, on the y-axis and the time it takes the bonds to mature on the x-axis. This relationship is normally upward sloping, meaning longer-term rates are higher than shorter-term rates. Why are short-term rates lower than long-term rates most of the time? Well, it has to do with the risk and uncertainty associated with lending money for longer periods. When you lend money for a short period, let's say a few months or a year, there's less time for things to go wrong. The lender has more certainty about getting their money back, so they're willing to accept a lower interest rate. It's a faster repayment and a less risky transaction. On the other hand, when you lend money for a longer period, like 10 or 20 years, there are more uncertainties that could affect the borrower's ability to repay. Economic conditions, inflation, and other factors can change a lot over a longer time frame, so lenders demand a higher interest rate to compensate for the extra risk they are taking by lending money for a longer period. A yield curve inversion refers to a situation where the yield curve, which typically slopes upwards from short-term to longer-term bonds, flips and then becomes downward sloping. In other words, it occurs when yields on longer-term bonds are lower than yields on shorter-term bonds. This inversion is often measured by comparing the yields on the 10-year and 2-year Treasury bonds, or the 10-year and 3-month Treasury bond. A yield curve inversion is considered a significant event because historically it has often preceded economic recessions. It is seen as an indicator of market expectations that the economy may face challenges in the future. Investors interpret a yield curve inversion as a signal of potential economic slowdown, lower inflation expectations, and a scenario where interest rates could remain high for a period before being adjusted based on economic factors. While a yield curve inversion doesn't guarantee an imminent recession, it has been a reliable warning sign in the past. Economists, policymakers, and market participants can closely monitor yield curve movements to gain insights into the overall health and direction of the economy. Thanks for watching today's video. For more investing tips, visit our website at claret.ca. And don't forget to hit the subscribe button below.